CNBC TV 18's Women and Money series, Financial Quotient, powered by For Her, an investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to CNBC TV 18's Women and Money series presents Financial Quotient, which is an investor education and awareness initiative by Aditya Birla Sun Life Mutual Fund. And today we're going to be talking about mutual funds, how to understand them, and how to build a portfolio around them. So, just to give you a perspective, the Indian mutual fund industry has grown 10 times in the last 14 years. It stands at close to 35 lakh crore rupees, 1/5 of the banking industry in India. And despite its massive size, as of now, India accounts for less than 2% of the global mutual fund industry. And, for now, less than 7% of Indian household savings are actually flowing into mutual funds. But this is a business or an industry which offers tremendous potential for growth. There is a recent report by Kavi which shows that Indian wealth is actually growing at the fastest pace if you compare it globally. So in India, wealth is growing at 28%. So there will be a lot more, wealthy Indian, and perhaps a good alternative could be mutual funds. So let's invite two experts to try and break this down for us, how you can invest in mutual funds and how you can benefit from it over the long term. So joining in, we have Dilshad Bilamoria, Managing Director at Dilzer Consultants, and Shweta Jain, founder of Investorgraphics. So thank you very much, Dilshad and Shweta, for joining in. Dilshad, my first question to you is, a lot of people in India, even now, still have this marked preference for physical assets, whether you take it as gold or real estate. Is mutual funds really the one answer that a lot of people could be looking for? Can you actually do a well-rounded, goal-based asset allocation through mutual funds?
Yes, thank you for having me on the show, Samira. So I think we are asset allocators for our clients at the end of the day. Definitely, there has been a shift from from real estate or fixed assets to financial assets. In the early 2000 or even before that, real estate was giving good returns and people were, making good returns on their portfolios. However, there has been a marked shift, and financial assets as of today are more than enough to realize one's goals when it comes to planning for one's finances. So it's very important to understand the return concept when it comes to measuring performance, which sometimes becomes difficult in a real estate asset since there is no real listing like we have an index today in mutual funds and in stocks and shares. There's no real listing as such for real estate, so it's difficult to track the performance.
Shweta, can you explain the various kinds of mutual funds and how to actually go about selecting one? Because normally when you'd want to select, people expect to have a short list, right? But we have close to 2,000 funds. If you look at the entire universe, it's very, very difficult for a person to know, what is the difference from, say, an equity fund to a hybrid fund to a pure debt fund.
Yeah, hi, Sumaira. So there is this variety of mutual funds that is available to us, right? And the problem is that there's too much, so we don't know how to choose, and we get into this paralysis where we can't make a decision for ourselves because we don't know enough, and there's so much information out there. So unless we are going to be really dedicated to this, it's really difficult to choose something, right? And unlike an FD or a real estate, where you say choose a bank and you choose your tenure and you're done. It's a fixed deposit and you're done. Real estate, you choose a property and you're done. Here you have this whole variety that is there, and there's in equity itself. There are So in equity, there's large cap, there's mid cap, there's small cap, there is flexi cap, there is multi cap, there, there is just so much variety. Then there is this whole debate of active versus passive. Then there is performance tracking versus cost tracking. There's regular versus direct. And I haven't even started touching upon the other categories, right? Just equity. And there's so many decisions to make. And you know what? We're like, okay, forget this. Let's just go for an FD or something. And there's, of course, ELSs. So there's this whole variety of mutual funds that's available, which is good, but also it becomes really difficult for one to take a decision. For me, I just make things really simple. Anybody who started off with a tax saver, because that's something that people really like to do, save taxes. So say start off with tax savers and start off with an index fund. So you have low cost and you have tax saver and you're done. You don't really have to keep checking and keep looking at competing. The other problem with I don't know if it's Indians or it's humans, we like to compare. So when we like to compare, we want the best performing mutual fund, we want the lowest cost mutual fund. I really don't know why we are competing against anything. Right, so we have to choose a good mutual fund, one that suits us, and that is the most important thing. What suits us is really important, and we are good. You may outperform your friend 1 year, your friend might outperform you next year, which is absolutely fine. I don't think that's something that we should sort of dwell upon. What we should just focus on is our goal, our suitability. Are we comfortable? Are we sleeping well at night? These are things we should focus on. But these are not glamorous, so people kind of tend to ignore that. Coming back to your question, so I'm just going to go not just to answer to your question, but a little more in depth, more wider as well. So there's equity, we discussed. There's hybrid, in which again this category of whether it's dynamic, whether it's a static sort of allocation, if it's a balanced sort of advantage funds, if it's equity savings. So there's this various categories even in hybrid, right? And then there is debt, which all of us want to say that is the easier category, but it's actually more difficult to make a decision in debt than in equity. I think equity is easier when compared to debt. So there's like overnight, liquid, short term, ultra short term, there's corporate bond, there's credit risk, there's gilt funds, and now there's target maturity funds. So there's this whole category of funds that are available to us. And once we design, actually, I think it's a simple step. The first step is what are you looking for? So if say I'm looking for safety or I'm looking for growth, and then decide which kind of asset you want. So we choose debt or equity, and then choose an easier one according to your tenure. I think we make life very difficult for ourselves by competing with us and others and making our schemes compete.
Yeah, that's true actually, because even if you were to just compare funds from, for example, say the large cap equity space, they have different ways in which they are managed, different ways in which stock selection is done, and those stocks behave differently in different business cycles. So it's very unfair to compare funds, depending on what their style of management is. Dilshad, because there is, no one yardstick for funds even within a category, how can people do the research? I mean, what are the, say, the top 5 things that you must look for when you're judging schemes?
I would look at both qualitative and quantitative parameters. So in qualitative, I would go with the fund manager's history and the promoter background, the AMC at hand as such. In the quantitative parameters, I would look at the technical parameters being standard deviation, Sharpe, beta, alpha, and then we drill that further portfolio wise for the client. We also get into scheme wise, we get into fund wise. So and of course things like expense ratio when it comes to choosing the right equity and debt funds. When it comes to selection in debt, I think we've seen in the last 2 years there has been a carnage when it comes to the credit quality of paper in debt funds. And therefore, we are very strict in observing that the kind of debt fund selections that we do always maintain a high credit quality. And it's not like you select it once and then it's going to last, for your lifetime. It would need a constant evaluation. It would need a check to ensure that you are in, safe funds. And like Shweta said, I think there is no one constant outperformer. There will always be one fund that will do well, say for a quarter, and then there'll be another that will again come out in the next quarter. So I think it's important to match one's goals with the objective and the time horizon. If one looks at these three broad parameters, I think they're good to go when it comes to their investment process.
Okay, and one of the first things that you'll want to consider when you look at mutual funds is whether you want to use the SIP route or you want to just, put in lump sum amount of money. So, by the way, before we get into that, there is a poll that we have for our audience. So, do get ready to give us your answers. The question is: do you invest in mutual funds through SIPs, systematic investment plans? A, yes. B, no. So please give us your answers. We'll read out the results in just a bit. But while you vote, let me get Shweta in on this. Shweta, um, for a retail investor, there's now a lot of evidence which strongly suggests that SIP is the preferred route, especially in terms of wealth creation over the longer term. Can you illustrate the benefits of compounding?
Okay, so for me, I think compounding, when I think about it, I go back to mythology. And there's a story that I really like, and I use this a lot of times to talk about compounding. I'd just like to share that story here. So there was a kingdom where the king was very happy with one of his ministers, and he said, "You're really smart. You've impressed me today. So ask for anything that you want, and it shall be given to you." And the minister says, "I want all the rice in what I can on a chessboard. So I want first, when I go to the first square, I want one grain of rice, and the second one I want the double of that too, and the next one I want double of that." So 64 squares are there on a chessboard, and I want the number of grains of rice as on each one. So 1, 2, 4. And the king laughs, and he's like, "Had you asked for anything, I would have given you. And you're so stupid. I thought you were smart. You're so stupid. You could have asked for gems, jewels, and all you want is rice that fits like a chess board. Okay, if that's what you want, let's give that to you." And he started with 1, 2, 4. And by the time they reached the, I think, 45th square or something, there wasn't enough rice in the kingdom to be given to the minister. Because if you see, there's close to, I think, 10 crores by the time you reach like the 30th, 31st, 10 crores. So when you start off with one, you feel that, okay, this is just 1 plus 1, right? That's how you calculate mentally. 1 plus 1. So the next, when you double it, it's two. So it's not a big deal. So when you double that, it's two, and two and two, it's four. It's not a big deal still. And most people often drop out at this point saying, "You know what? Equity is not for me. I don't really have that luck that others have in multiplying their wealth, and they just drop off in the first phases, in the first 2, 3, 4 phases. Whereas the money is to be made is by staying in it for the long term, right? So the difference between, say, the first and second square is one grain of rice. The difference between the 29th and the 30th uh, chess, the square, is almost 5 crores. So it seems really small. And unfortunately, in India, the stories that we hear about compounding wealth are only of real estate. Everybody has heard a story about how the property that their father had bought for, I don't know, 50 rupees, or 200 rupees or 1,000 rupees, and then sold for crores of rupees, right? So everybody has heard these stories, including me. None of us have heard stories where equity has multiplied their wealth, has given them one, say, 100 or 1,000 or 2 lakh, other than the WhatsApp messages that you and I see of Infosys shares given, had you bought at so and so. But other than that, so we think of these as outliers rather than these being the norm. So I think now people are understanding that in equity, the longer you stay, the more money you can make. It's possible. I think they've seen that. But the last 1.5 years again has been difficult because people who entered the markets in the last 1.5 years think that this is how it's going to be. This is how the journey is. So that again is slightly dangerous. But I think when you see money being compounded like that, your money compounded like that, that works fantastically. One feature that equity has that real estate maybe doesn't have is of immediate liquidity. And that, I think, it's a great feature, but it works completely against it as an asset class also, right? Because the minute I panic, I can just click a button and it's sold. Unlike property, where you still need to go through processes, and then in that time period, you could change your mind. But here you see markets falling, there's red, there's panic everywhere around you, and you just click a link and you exit. So what is a great feature becomes its great negative trait for you. It works against you as well. But I think these are stories that we are starting to see now, and I think that's really great.
Yeah, Shweta, you've touched upon a very, very important point. And by the way, just to illustrate this point on compounding, legendary investor Warren Buffett said he started investing at 11 and he regrets that, it was already too late for him. So, that's how much weightage the best minds in the world give to staying invested and to starting early. By the way, we have the results of the poll. 68% of the audience agrees that they invest through SIPs, and only 32% says that they don't. So this is quite heartening. Dilshad, Shweta, I'm sure you'll agree. But Dilshad, anything more that you want to add on SIPs? Because we see very often that the emotional aspect of remaining invested plays a very, very large part, especially when it comes to SIPs. Because when there's first sign of panic, people stop investing, and which is where you should have actually continued. So any house rules to live by?
I'd like to answer that from two perspectives. One being in terms of my goals, right, or an investor's goal. So obviously, the very nature of a systematic investment plan or an SIP is its convenience, is its flexibility. You can start it, stop it, you can increase it, you can reduce it, you can take a sip pause. So these are the flexible issues to it. And therefore, if I'm looking at long-term goals, typically beyond 5 years, I think the best route today would be to go with equity or hybrid, depending on your risk profile, and through an SIP route. The other perspective is when it comes to the market, and this is where there has been a considerable debate, among researchers, among analysts. Now, everybody asks which is the better route to invest. Should I take an SIP route? Should I take a lump sum route? When it comes to pinning down the actual numbers on this, okay, if the markets are in a trough or are continuing to move up, then a lump sum investment works well. However, if the markets are volatile, then an SIP. And as you know, SIP helps in the value cost averaging concept or the rupee cost averaging concept. Today, SIPs come with a great deal of offers in terms of even investing higher amounts in equity, depending on the PE of the market. So, for example, if a market is overheated, typically the fund would invest lesser in equity, and vice versa if the market is fallen down. At the end of the day, I think for a simple investor to just start their journey, the best way is allocate at least 15 to 20% of your take-home income towards, investments. It could be through SIPs, it could be through lump sums. Like I said, there has been a lot of debate as to which mode sometimes works better. It would all depend on your fund availability and what are the resources at hand. But yes, do start investing, as the power of compounding is the eighth wonder of the world.
Okay. And, by the way, another point that I want to highlight over here is that according to data which has been released by the mutual fund apex body, which is AMFI, they say that now 40% of investors are using the direct route. And if from within this we cull out the portion of retail investors, then they say that 16% of retail investors are investing directly as of 2020, as opposed to 13% as of September 2019. So there is a lot of growth in terms of this DIY aspect. We're also seeing it, in the direct stock market investing as well as in mutual funds. So before we go further, let me in fact get in the next question as an audience poll, which is that would you take the help of a financial advisor to build a solid financial plan? As always, A for yes and B for no. I look forward to reading your responses on this interesting question. Shweta, um, how do you read this whole rise of the DIY investor? You think this is something which can be, done by an investor who also has otherwise has a day job, or do you necessarily need professional advice?
So I think if you are somebody who can spend some time and can control your emotions and understand a little bit, you can manage your portfolio, at least when you're starting off, right? When you can afford to make mistakes. Uh, so this is the time when you're learning. So whatever losses you make or whatever mistakes you make, you can charge it out to like a course fee, saying this is my course fee and that is how I'm learning about this. But the problem happens when you're investing, but at a time when you should be, say, doing X, you're doing completely opposite, right? So, for example, when markets are correcting and you should be investing, you are panicking and you exit, right? So that is when it works against you. But otherwise, I think it's fairly simple to do this, but it's not easy, right? Because you have to understand your requirements, you have to understand the product, you have to understand markets, and you have to at least keep an eye. You can't just fill it, shut it, forget it. I don't think that's how it works. You have to keep an eye. You have to not just look at products, you have to look at markets globally, what's happening. So you have to keep at least an eye on some of these things. So if you're dedicating your weekends to this, I think you're still okay. You don't have to worry about it too much. But unfortunately, money is not really taught about in schools, right? Um, it's not a conversation that people like to have either as families, which I think is doing a disservice to the next generation or to our generation for that matter. And when money is not a conversation that is done easily, you are uh, not comfortable around some of these things. You don't know what values you have, what you should be doing. You don't know basically anything about it, right? How to spend, how to budget, how to save, how to invest. There are some lessons that we learn which may not be correct. For example, some of these lessons may be relevant for a parent's generation, and the advice that they give us while coming with your interest at heart may be completely wrong for you because of your situation. I'll just give you an example, right? So most parents tell their children to buy an insurance policy, which is, say, a traditional investment product, right? It's great advice because they're asking you to save, but it works completely against us because there are better options today than they were, say, at the time of their investments, right? So there were no mutual funds back then. So this part of our money is then blocked. Earlier, maybe they started work at the same place, they retired at the same place, so they didn't move around so much. Today we are, the world is our oyster, so you're moving out to another country. Then this becomes sort of a difficult thing, plus you're then blocking a lot of money for relatively much lower cover. A lot of the products that I see with clients are 10 lakh cover, or 12 lakh cover or 15 lakh cover, not more than that. So that cover is really irrelevant. And 5-7 years down the line, and they're like, this is just, let's throw good money after bad, because otherwise it's I lose out even what I'd invested in. So while that advice is coming from a good place, it's not the right advice for us, including buying a house or blocking that money. So it is really important for us to understand our own needs, and that itself takes time for us to pull out of that person, that what are you looking for, and that itself, I don't know what I'm looking for. It's very difficult for people to see beyond 5 years, for example, and say, you know what, I don't know. And you're asking me to block money for 20 years, 30 years. I'm not comfortable. I don't know what I'm going to do. So then, when you don't understand yourself, how will you choose the products? How will you choose schemes? And just doing, cost analysis, for example, say there's a difference between, say, direct and regular, say 1%, and you compounded it, of course, work really huge over time. But if that 1% is the cost of my peace of mind, if that 1% is the cost of getting good advice, of staying invested, of doing the right thing. For example, the people who start with us, say, start off with 1,000 rupee SIP, but then move to, say, 10,000 almost immediately. And you'd think that, there is no savings potential. There was. They just didn't tap into it. They would just spend everything, right? So just that one point makes the whole difference, right? Just nudging them to save more, for example. So I think if that 1%, or whatever the fee is a fee for you to do much better in life further, I think it's a fee that you should be willing to pay for.
All right, it's a fair point. It's a fair argument as well. By the way, 66% of the audience say that they would take the help of a financial planner to help them build a solid financial plan, and 34 do not agree. Dilsha, just to labor this point further, there are a lot of people who say that there is this trust issues. They're not sure if they're getting the best advice. So and the crux of it would lie in finding the advisor who's best suited for your needs, right? So, therefore, what are the few questions you would ask an advisor to know whether or not you're on the same page and whether or not you're going to get the best advice?
Yes, that's a good question. So, I think the investor of today does a lot of background check when it comes to choosing their financial advisor, and the checks could be, what is the qualifications, what are the certifications, what is the experience. A lot of people are also aware of what are SEBI registered investment advisors, what are certified financial planners. So I think it's important, for the investor to look at the certification, qualification, experience, background, and it's always best to start with the planner by asking the financial advisor, who would you recommend, so that we could speak to them and possibly, find out about how you have been providing your advice and services. I think the test of a true financial advisor is to solve the problem of the client without productizing the solution. If that is maintained at any level in the interaction with the client, I think that is the basis of trust, and that is where you've won the trust. And differing from, say, and I don't mean to put down bank managers, but they keep transferring, they keep moving. There's changes. A financial advisor is a sounding board, is your guide for your entire life. Importantly, they are there to control behaviors, and we all know behaviors change drastically when it comes to changing life events, when it comes to changing market conditions, etc. This is where actually the financial advisor's expertise is there to bring the client back to reality and ground to help the client.
Yeah. So an advisor's job is more than just the act of buying and selling the investments in your portfolio. It's also to act as a voice of reason and to handhold their clients through difficult situations. But before we move forward, let me have another question for our audience. By the way, we're also going to be open to answering audience questions in just a bit. So those of you who have any questions, do start typing them in. We'll curate a short list and get them answered by our two experts. So the question now to answer in the poll is, what is your investment horizon? A, 3 years, B, 5 years, C, 10 years, or D, 15 years? So those are your four options. I look forward to hearing your answers. Um, Shweta, once you have sort of understood the basics of, mutual funds, etc., a lot of people, instead of creating these holistic portfolios, actually become gatherers of product. There's an NFO, they think it's cheap, so therefore add that in. I mean, some portfolios are very, very big and unwieldy. Which is the right way to actually avoid this? I mean, we've heard a lot of what to do, what not to do, so that you have a sound financial plan in place.
So what not to do, the list I think is longer than what to do, but just to talk about some of the points. So don't copy your friends or your colleagues or their portfolios because something that may be right for them may not be right for you. So don't copy, don't compare. I mean, this is a recipe for disaster if you're going to start copying and comparing. So that's something that one should not do. I've seen portfolios with as many as 50 schemes. So nothing surprises me anymore, actually. So these are things that people just sort of keep accumulating, right? So you keep sort of hoarding these schemes, and then it becomes very difficult to do a declutter because then you don't know what you should be doing, what you shouldn't keep. And there will be some which have done extremely well. There've been done some which are not doing well at all, and you don't know what to do with the portfolio. So what people generally would do is something that's doing well, you would sort of keep adding on to it. Something that's not doing well, you keep reducing it, right? So, and they compare debt against equity as well and hybrid against each other, right? So these are things that I don't think you should do. Also, something that people should definitely not do is push your debt portfolio for that little extra return that you're going to make, right? So if you see a debt scheme, one scheme versus another, and you see just the performance, and you see, okay, this is slightly higher and let me choose that, I don't think that's the right way to compare as well. I definitely recommend a debt for your safe sort of haven and for your goals which are within say 3 years. So these are things that you should sort of take care of. And I know while we don't talk about selling equity at all, I think one of the things that people don't do is they don't sell equity till the last sort of minute of their goal, right? So keep your goal in mind is what I keep telling everybody. Keep your goals in mind. So if I have a goal for which I've been saving for the last 5 years, 10 years in equity, and that goal is due, say, next year, start liquidating at least a year in advance, because you don't want to leave these to chance and sort of jeopardize your goal. You should start liquidating it closer to the goal, a year at least, not absolutely at the time of the goal. So that's something that people don't do. They panic at the time of markets and then they withdraw. I just had a discussion yesterday where a client said, this I was supposed to withdraw this a month ago, and it was at 19.23 lakhs, and now it's 18.3 lakhs a month later. Now what should I do? She stayed invested because she wanted to say make a little more money. So you just think that equity is just going to move up, but that doesn't work, right? So if you need the money a couple of months ahead of the goal, you is when you should start withdrawing and start moving it to debt. Don't take it in your bank, because again, if it's in your bank, you're going to spend it for something else. Move it to a debt fund, like a liquid or an overnight fund or an ultra short, depending on what time horizon it is. But move it to safer where you cannot reduce further. Equity, remember, all said and done, equity is going to be volatile. So what you did see day ago will not be what you will redeem. So remember that. We sometimes forget that equity will come down as well. And especially in times like these, every day sort of is different. So make sure that you are focusing on your goal. And one more thing that people don't do is see how much they need to save for a goal. Um, we work best when we have targets, right? And I think humans are fantastic adapters to anything, whether it's to our lifestyle even. So I think people don't save enough for a goal because they just don't get into the this is where I need to go, so they don't realize how much they need to save to get there. So I think that is a calculation, or that is an introspection that people should definitely do, and say what they can and what they should, rather than what they just easily sort of is set aside. Say what you should be setting for your goal.
All right. Good points to note. By the way, 53% of the audience say that they invest for 10 years. We have 18% saying that they even look at 15 years, so that's good. 17% say that they're short term in nature, so looking at a time horizon of 3 years, and 12% say that they look at a time horizon of 5 years when they're investing. Dilshad, the other thing to talk about when we're looking at creating a portfolio out of mutual funds is diversification. Now, it can be on many levels, right? One is, say, at an AMC level. The other can be at fund level. Even within funds, you have various styles of management. Somebody's, has a growth portfolio. Somebody has a value-oriented approach to investing. How much diversification is too much? I mean, where do you draw the line, and what would an ideal portfolio look like?
So, when it comes to diversification, I think that is the crux of any investment planning. Within mutual funds, if you were to ask, I think the broad classifications are equity, debt, and cash. But in equity, you have possibly you can have a core portfolio, and you can have a satellite portfolio. You can have a cyclical portfolio. You can have a low cost index based portfolio. And of course, within that, there are further drawdowns. For example, in a core portfolio, typically one would look at an index based investment or a large cap. Or in a satellite, one would look at riskier kind of mid cap or small cap kind of allocations in equity. And then on the debt side, you have duration kind of portfolios. You have accrual strategies. And in cash, there is again another list of at least five, six, where you start with liquid, move to ultra short, low duration, short term, etc., depending on the time horizon of your investment need. So I think when it just comes to mutual funds, if you were to divide your portfolio between these three asset classes broadly, that would take care. However, one must look at other diversification as well. And by that, I mean investing in, say, some amount in gold, so between 5 to 7% in gold, or some amount in international equity, some amount in, if you are a very high risk investor, some amount in private equity. The idea is to try and keep it as simple as possible, but at the same time to ensure that your portfolio is well diversified, so that any market downfall is well protected. And therefore, I would think that too much diversification is not bad, but holding too many schemes in one's portfolio is bad, and that makes it unwieldy. But when it comes to diversification and asset allocation, I think this is the base and the most important while selecting one's investments.
Okay, and just another reminder to everybody who's watching to keep sending us your questions. In just the next few minutes, we'll take it up with our two experts. So if you have something that you'd like to ask, Dilshad and Shweta, please write into us. And also, here's another question for you to answer, which is, how often would you look to review your portfolio? Your options are A, every month, B, every 3 months, C, every 6 months, and D, annually once a year. So I look forward to hearing your responses on this. And as you type in, let me also pick Shweta's brain on this. Shweta, some people say that perhaps a review should be of a market cycle. Some say it should be periodic. Some say you do it when you're doing your tax planning. Is there a science to it? Or do you just sort of do it at whatever predefined interval that you have?
I think you should do it at a predefined interval, so it takes the emotion out of it, but also do it at a little more market centric as well. So what I mean by that is, when you are looking at your portfolio quarterly, you know where what is missing, what is to be done. And I don't just mean you look at your, say, mutual fund portfolio and say, okay, the scheme is doing well and this is not, so let me change that. No, just see what is happening to your portfolio, see what investment sort of focus you need to do. If anything has changed in your life, whether it's addition to the family, job change, anything that is changing, once a quarter is a good time to sort of just review anything, your expenses even. So I'm just looking at my portfolio and I'm thinking of, five other things, because these conversations sort of come up. This could be a conversation with your partner as well, so, or your child who's getting older, depending on one's life situations. Once a quarter, I think a good time, but not a good enough time to make changes. Once a year is something that I would definitely recommend people to look at it in more in depth, and look at, say, what has happened. Markets have changed, portfolio has changed. What was the asset allocation, say, when I started off with, where should I go from here? Usually we have these blinkers of saying, okay, so it is at 70 versus 30 today, so let me just go ahead from here. I think we'd do well if we've made notes of where we want to go. So a sort of a vision board helps us in that, and see what has changed for us. So what has changed in our life should reflect your financial portfolio as well. Your portfolio, when I see, I should be able to tell you what is for short term, what is for long term, what kind of an investor are you. I should be able to talk about your personality from your portfolio. So that is how I see somebody's portfolio, saying, okay, so you are investing so much. Okay, so how much are you earning? How much are you spending? Where do you want to go from here? So there's all of these conversations that start off with. Once a year, you should also review your asset allocation. So if you say you started off at 50-50 at the beginning of the year, you can decide your year. It doesn't have to be calendar, tax, whatever, you can choose what's a good time. Usually people like this to be like a calendar, because then you can, the January 1st, you can make those changes. Or if you find that too overwhelming, make it a tax year, a financial year. So April to March, so review that, or anything in between. Choose your pick. So you can decide when you want to review, but when is not as important as what you will be doing. So if your asset allocations decided was 50-50 and now it's 70-30, forget whatever markets are doing. You do what is right for you. Do 50-50 again. So what you do while doing this is take the emotion out of investing. What you also do is, say, when markets have moved up, which is why your equity has moved up, right? You're booking profits, right? So while compounding is great and you have to stay invested, your asset allocation is even more important, and you're just booking what is extra, right? And you move to debt, and vice versa. Say markets have corrected and your equity from 50 has become 30. Take out the emotion. So what do you do at this point? Markets have corrected, but your asset allocation is telling you to add. So add. So this way, you're taking out the emotion out of investing, and you're rebalancing your portfolio periodically, which is annually, I think is fine. And you look at your goals as well, so you know what money you need in the short term. Has there been vacation that needs to be planned, that or children's fees that need to be taken out from whatever it is. So you take that look. So I think once a year is a good time. Once a quarter you can look at it, but don't make too many changes. I think the tendency for us to um, touch something is very very high. Rather just for example, when you're starting to do yoga for example, the minute they ask you to observe your breath, you start changing it. You start monitoring it, you start to breathe deeper or whatever. My thing is just observe at the quarter, don't change anything, and then change at the end of a year, change annually.
Okay, in fact, you have answered the question that we have got from one of our audience participants, Seema, who wanted to know how often does one need to review or monitor their portfolio. So, Seema, there you have it. Once a year would be a good time to do. Dilshad, would you agree that an annual, reinspection is a good thing? And also, if I can just add to this, is that what do you look at when you review? Do you just sort of rebalance the portfolio? How do you take the decision to weed out the non-performers? Because, every underperformance is not because of a fundamental deficit in the fund.
I would look at three or four, kind of reasons why one needs to rebalance a portfolio. One is obviously because of profit booking, right? So, and that's the whole genesis behind portfolio rebalancing. So, the idea is if equity has outperformed like it has in the last 2 years and it's gone beyond your target asset allocation, which might be say 50%, and it's gone to a 65% purely because of a capital appreciation, then it's time to rebook those profits and move them into safer investments. So that's point number one. Point number two is definitely if I have a debt or a loan to repay, I would do an analysis of what are the returns that I'm earning on my investment vis-a-vis the loan rate that I'm paying, and accordingly take a call and rebalance the portfolio once again. Third, I would look at the goals that I'm planning to that I've laid down for myself and my family. And here again, I would look at if I'm closer to the goal, I would protect the downside volatility and move into something which is less volatile, like an arbitrage or a liquid. And very importantly, Sumera, I think taxation plays an important role here when it comes to portfolio rebalancing, right? So at the end of the day, what we need to do is to help our clients even reduce their taxes. So typically, if it is, like I said, a debt fund, you would typically wait for 3 years because you get the indexation benefit. If it's equity, you wait for 1 year. So I would more look at the life stages or the requirements of my goals and accordingly plan for the portfolio rebalancing.
All right, so that's a good holistic way of looking at things. Payal wants to know if there is a minimum lock-in period for mutual funds. Yes, Payal, some mutual funds do have lock-in periods, but Shweta, you want to explain, which funds have lock-in periods and how to, when it makes sense.
So there are funds with lock-in periods. For example, equity-linked savings scheme where you're investing to save tax will have a lock-in period for 3 years. There will be funds with even exit loads, for example, which may not have lock-in, but they will have exit loads. So that is to discourage you from withdrawing before the time that you sort of need to stay invested, the optimum time. So there are different kinds of lock-in periods, so to speak. That is why your time horizon becomes really important, and matching the scheme that is there for that time horizon is really important. So while you may have for example, a 3-year horizon, um, equity linked savings scheme could be a right one for you. But if you're doing an SIP, each entry will have a 3-year lock-in, so you have to be cognizant of that fact as well. A lot of times people forget that, and they think that's just the time that they've started that counts, but it is each investment that has been done. So that is, I think, important to sort of note as well.
Okay. Kavita wants to know if investors should be staggering their investments rather than committing a lump sum amount. I think we've already spoken about this, but Dilshad, anything more that you want to add here?
Like I said, the important thing is to invest, whether one looks at lump sum, whether one looks at SIP. I think that would be dependent on so many factors, both technical, like I said, market based analysis, research outcome, as well as your goals, as well as your time horizon. So I think these are the important questions that an investor needs to ask the financial advisor and themselves. And once these questions are answered, they're able to take a decision. If you would just like to start and you're starting your investment journey, I think the best way is through the systematic investment plan because, like I said, it's liquid, it's flexible. You can increase, you can decrease, you can start, you can stop, you can pause, you can have an additional add-on to it. You can even have algorithmic kind of trading in SIPs. So there is so much that the industry has to offer. And definitely, the financial advisor can guide you on that.
Okay, we also have the results of the poll that we had conducted. So we have 36% of the audience saying that they'll review their portfolios monthly. 24% say that they review it annually, 60% say that they review it every 6 months, and I think another 20% who say that they review it, 20% say they review it every 3 months, as well as the similar amount of people reviewing it every 6 months. So I guess annually is the way to go. Reviewing it too often will only cause a lot of perhaps decisions to be taken in either extreme greed or extreme fear. Shweta, one more thing that I want to sort of ask you before we wrap up over here is, uh, a lot of people, when they're looking to diversify, like, we had discussed that they have either physical real estate or they have gold, etc. Should they now consider adding, say, REITs or gold ETFs, etc., make everything paperless?
Yeah, I think that's a great way to sort of manage your portfolio with the kind of lifestyle that we have, even, right? I think it's important to have a diversified portfolio, but it's also important to make sure that you can manage it well. So having everything paperless, like you said, makes that easier, makes those decisions faster. Also, having said that, I think there are various other advantages also. For example, having um, simpler or lesser amounts to invest. If you wanted to invest in real estate, you'd end up basically committing a huge amount, plus they maybe even take a loan, without which you wouldn't have a decent exposure or you wouldn't be able to invest in it. But with real estate mutual funds, that becomes a possibility. Gold, for example, that becomes a possibility. So the ease, the convenience, the amounts, the perfect diversification, the way to sort of manage it. For example, gold, one will have to physically store it otherwise, which brings its own challenges. Real estate, managing a plot of land or property itself could be very time consuming, could be very expensive, even, could be difficult. There could be other issues like encroachment. So I think all of these with mutual funds becomes a real possibility, and I think that's such a great way to invest. And then also equity brings it at the same table, at the same level, right? So you tend to have everything at your fingertips, at easily liquid, and making sure that different asset classes you have exposure to, so you have the adequate amount of diversification. You are now then not comparing, but at least have an ease of investing in all of these asset classes in a fair manner. And even if you're traveling, if you're settled in another city, another country, you're then not worrying about, what happened to that property, or what will happen to my gold, how am I going to carry it. You don't have to worry about all of that. So I think this is such a great way to invest in these asset classes, which otherwise may be slightly difficult to manage.
Okay. And one final question coming in from our audience, Rima, who says, are SIPs and mutual funds the best route of investment? Rima, I think both our experts have answered this. In fact, Dilshad had explained when lump sums might work. But yes, by and large, SIPs is the best way to go. But let me, add to this question and ask Dilshad one final question before we wind up. Dilshad, a lot of people, they come in to money. If you have an ongoing salary, so there is no trouble. You get, your monthly salary, you have an SIP allocated. A lot of people come into money. Would, that lump sum go in, say, in just one or two stages into your mutual fund portfolio? Or would you recommend maybe something like a systematic transfer plan?
Right. So that's again a good question. Again, this decision would depend on which part of the market cycle that we are in and which stage of entry that we are entering the market. Are we at the trough? Are we on the rise? Are we at the peak? Are we on the downturn? Very importantly, this is what a financial advisor or a wealth manager would do, right? So to evaluate what is the price earning, what is the how overvalued or undervalued a market is, But typically, like I said, if the time horizon on equity and one's goals are say 5 years plus, and we saw that in most of the investors who have given their feedback saying that 5 years, 10, some have even answered 15, which is fantastic. I think in those things, the systematic transfer plan where you transfer a fixed amount from liquid to equity again is a good decision point. And here again, I'd like to add, how much does one transfer and what is the frequency? This again is a science. So this would again depend on what stage of the market cycle we are in. So if we are again in a very highly overvalued market cycle, then I would tend to ask my investors to spread their allocation for a longer time period for a systematic transfer. Vis-a-vis, if I'm at the trough or the bottom of a market cycle, I would typically ask them to shorten the STP period and make the investment choices accordingly. So it's very dependent and it's very dynamic based on the market conditions, Sumera.
Got it. Thank you so much, Dilshad and Shweta, for joining in today and for helping our audience understand, mutual funds and the best practices which are associated with building a portfolio. So, for everybody who's watching, I hope you have enjoyed this. I hope this has been an enriching and a learning experience for you, because really mutual funds do remain one of the best instruments which you can use for long-term wealth creation. So thank you very, very much for watching. And if you have any further questions or comments, we do look forward also to hearing from you. Thanks very much. Stay safe.
CNBC TV 18's Women and Money series, Financial Quotient, powered by For Her, an investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.